You know that moment when you're watching the market and it feels like something big is about to happen. But you're still not sure if you should take the setup? Yeah, that hesitation usually comes down to one thing. You're not reading the change in the state of delivery, or CSD, properly. CSD shows you the exact moment the market actually shifts and becomes ready to deliver a real move. In this video, I'm going to break down why I use CSD, how it connects with displacement and sweeps, and how understanding it can literally stop you from entering too early or too late. I'll show you what a real change in the state of delivery looks like on the chart, and what you should focus on if you want cleaner, more confident entries. Alright, let's get into it. What is change in state of delivery? A change in state of delivery is basically the moment the market changes its behavior. Price takes liquidity on one side, and then quickly shifts in the opposite direction with strong momentum. When that happens, and price closes past the first candle of that move, it tells us the delivery model has changed, and a potential reversal is forming. If it's a bullish CICD, price closes above the down-close candles. If it's a bearish CICD, price closes below the up-close candles. Overall, CICD is the first clear sign that the market is switching direction, and it's one of the best ways to catch reversal entries on any timeframe. The CICD forms when you get a series of consecutive up-close or down-close candles. It's based on the last candle in that sequence, but the important part is that the final candle flips to the opposite color. For it to be valid, the body of that opposite colored candle has to close either higher or lower than the previous candle's open or close. When that happens, that's your confirmed shift in delivery. The important point to keep in mind is that in a market delivery shift, our focus is on the closing of the candle body, not the wick. In a bullish CICD, price first takes out sell-side liquidity, meaning it sweeps the lows. Then it quickly shifts and closes above the open of the initial bearish move. That close tells us the delivery has changed and a potential upward reversal is forming. In a bearish CICD, price takes out buy-side liquidity, it sweeps the highs. Then price shifts and closes below the open of the initial bullish move. That close signals a change in delivery and a potential downward reversal. A real change in state of delivery is confirmed by three major signatures. 1. Liquidity raid. To truly understand a change in the state of delivery, you have to look at it in context, and the context always starts with one question: where is the liquidity? Just like every strong ICT setup, everything begins with a liquidity raid. When liquidity gets taken, you instantly get a clear invalidation level. And if you also have SMT divergence, the setup becomes even stronger and more reliable. For example, in a bullish CICD, the market first moves lower, taking out some internal lows, and then displaces upward through the most recent high. But for this move to make sense, there must be buy-side liquidity sitting above. The market needs that liquidity in order to sweep it and push price higher. So, a CICD is not a random move. It's a structured shift that happens around key liquidity zones. Understanding this context is essential before trying to trade it. You should also know that CICD usually forms alongside some form of manipulation. What does that mean? It's the final move of price against the main direction before the real shift happens. For example, if price first moves lower and then pushes above the previous high, that's when the CICD is confirmed. In other words, the market takes liquidity through a small manipulation, then changes the delivery model. Price must attack and remove liquidity before any true shift in delivery can occur. This typically happens when the market targets zones where traders place stop orders, equal highs or lows, previous swing points, or well-known session liquidity pools. A liquidity raid shows that smart money is clearing out resting orders to free up liquidity for the next move. Without this liquidity grab, the market is usually not ready to shift direction. It confirms the move is intentional, not random. Number 2. Displacement, FVG and IFVG. Right after the liquidity raid, the market must show clear and undeniable momentum in one direction. This is the moment when smart money reveals its intention, and we often see this through the formation of an FVG. You'll typically notice large-bodied candles with small or no wicks, multiple imbalanced candles forming consecutively, and a decisive shift in delivery. This FVG is important because it confirms that the liquidity grab wasn't random. It was the fuel for a new directional move. Strong imbalance shows that one side of the market has taken full control and that a new short-term, or even higher timeframe trend is beginning. On the other hand, the IFVG is another key element that shows the strong price movement has invalidated the previous gap. A clean IFVG forming after displacement confirms that the old structure is no longer respected. It also provides a high probability level for price to retrace to, making it an excellent area for entries aligned with the new direction. When a CSD forms together with an IFVG, it clearly indicates an order flow shift. Always use CSD in the context of higher time frame bias. For example, if you expect bullish order flow from a higher time frame key level after a mitigation, you can confidently execute the trade using a single CSD with an IFVG. And number 3. Market Structure Shift or MSS. The market structure shift in the direction of displacement. This confirms the flow has changed and you're no longer dealing with the old delivery model. Alright, let's look at an example together on the chart. This is the pound chart from last week. The daily bias on pound was bearish, and since price was approaching a 4-hour FVG, I was looking for short positions. So the first step was checking the context. As you can see, after taking the liquidity above the previous high, price moved downward toward the low. And yes, since it closed below the body of our green candle, we got our second confirmation, which is the CSD. Now, to increase the probability of the trade, I look for additional confirmations for my entry. Entering directly on the CSD doesn't give me an ideal risk to reward, because my first target is the equal lows. So I wait for price to retrace back into the premium zone. Inside the premium zone, I have an FVG sitting right at a breaker block and order block, which together create a high-quality entry area. If price returns to this zone, I can get roughly a 1 to 3.5 risk to reward. Another confirmation is the SMT divergence that pound formed with euro, which gives me even more confidence in taking the trade. So I wait for price to reach my zone and I take my entry there. Now you may ask, why didn't I enter on this IFVG, or even the lower FVG? The reason is simple. Based on my backtests, when a breaker block and an order block form within the same zone and there's an FVG inside that zone, the probability of success becomes significantly higher. As you can see, price reached our target zone and I captured my desired reward. I've mentioned this before, and I'll emphasize it again. When liquidity is used as a target, it significantly increases the probability of a successful trade. Alright, let's move on to another chart, this time GBP to AUD. This is another trade I personally took. First, we need to check the higher time frame. Look here, I had equal lows on the 4-hour chart, and a few pips below that there was a daily FVG. The market's movement to create liquidity, along with the SMT divergence I saw versus the euro to Australian dollar chart, convinced me that a bullish move could happen here, targeting the equal highs liquidity above. I waited for price to reach the FVG and sweep the liquidity. Let's switch to the 1-hour chart to see more clearly what happened. After touching the FVG and sweeping liquidity, price moved upward, and once the liquidity sweep was confirmed, it gave us a CSD confirmation. At this point, I already had SMT, liquidity sweep, and CSD confirmations. I didn't need to complicate things by chasing more signals, especially since my risk to reward was already 1 to 4. I also used my standard deviation confirmation, which aligned perfectly between -2 and -2.5 with the equal highs. So I entered on the CSD to capture my desired reward. As you can see, price moved beautifully to my target before retracing down to this FVG. Of course, there were also FVG and IFVG confirmations on lower time frames. Here, I've included the 15-minute chart so you can see it more clearly. Okay, it's enough for today. I hope you found this video helpful. If you did, don't forget to like and leave a comment. Thanks for watching.